if you want to use leading indicators and catch trades like this and this, then you want to pay close attention. Because in this video, I want to debunk some common mistakes that traders make with leading indicators and then show you how institutional traders use leading indicators correctly. So many traders get all excited about leading indicators because it is supposed to be leading, right? Much like a crystal ball that can forecast what price will do beforehand. At least that's what I thought until I start applying them and lost a lot of money. Looking back, I wished someone made a video like this explaining how to use them correctly. Now, just in case you do not yet know what leading indicators are, leading indicators are designed to anticipate an instrument's future direction, meaning to say that you will know the levels beforehand. Some of the common leading indicators include the Fibonacci retracement, Fibonacci extension, and pivot points. As you can see from these indicators, they project a future price level you want to pay attention to. And time again, I see a trader simply trade off the level, expecting the price to just start reacting off the level. That's not the correct way to do it, and I'll explain more shortly, so keep watching. If you are confused and struggle to differentiate between a leading and lagging indicator, I've previously uploaded a video differentiating the two and how institutional traders combine both leading and lagging indicators. I recommend checking that video out next, and I will leave a link to that video at the top right and at the end of this video. But for now, please do me a small favor and hit that thumbs up button and subscribe to this channel. It helps this channel grow and I would really appreciate that. We also do a giveaway worth $99 for every new video that we release. So if you wish to participate in our giveaway, do look out for an emoji somewhere in this video and comment what the emoji is plus Forex signals. The full instructions can also be found in the pinned comment down below. Now let me address the incorrect way to use leading indicators, which is trading off them without considering the market context. So what a newbie trader might do would be to load up a leading indicator like the Fibonacci retracement. Connect the swing low to swing high and wait to randomly buy at the 61.8% level. Do you want to take a guess what he's doing wrongly here? Well, as you can see, we are in a ranging market. And the right play for a ranging market is to buy low and sell high, not catching a retracement. So the mistake is in using a Fibonacci retracement, which is a retracement tool to catch pullbacks in a ranging market. Now, suppose the newbie trader is a little more experienced. He avoids these rookie mistakes and uses it in a trending market because, well, he has been watching the videos in this channel. So he has considered the market context. Well, the next big issue that might potentially trip him up is to enter blindly off level. I know many of you are making this mistake, so please pay close attention and keep watching. This will save you so much heartache. So again, he draws the Fibonacci retracement tool from low to high and looks at the 61.8% retracement level to buy. Thinking that is the magic level and hey, a Fibonacci level is a leading indicator after all, right? So he enters the trade without watching for any price action confirmation or what I call a trigger. He might even use a limit order to place in the trade so that he doesn't have to stare at the chart all day. That sounds easy, isn't it? Except that this doesn't actually work and you will most likely lose money if you trade like this. So please don't do it this way. So what a trigger is a cue that now is the time to enter the market. An entry trigger is the fine line between when you should wait and when you should click the button and enter the trade. So rather than watching for a trigger, he enters and this is what happens. A losing trade. If this is your experience so far, then you need an entry trigger. This is the missing ingredient that you need. It's not that leading indicators don't work. I've been using them for ages and they still work till this day. Rather, it is how you use them. I will show you a couple of examples to illustrate what I mean, so keep watching. Now obviously, I can't go through every single leading indicator and price action trigger, but I think you should get the idea if I were to show you these examples. If there's something not clear or a combination of a leading indicator and price action trigger you'd like to see, do leave a comment below and let me know. Suppose we use the Fibonacci retracement tool and we combine this with market structure, and we look to trade off the 61.8% retracement level. Now, rather than entering in blindly at the level, we use an engulfing candlestick pattern as our entry trigger. So price flirts around the level and eventually gives us our entry trigger here. Earlier, I mentioned that an entry trigger is the fine line that determines when you should be waiting and when you should pull the trigger. Notice that the entry was only taken after the trigger and not when the price first touched the key level that we were interested in. This is the proper way to use leading indicators. You should never enter blindly off the level. I could even show you a couple of examples where price just broke through the predicted level as if that level wasn't a key level. Here's another example, this time a bearish scenario. Using the Fibonacci retracement and focusing on the 61.8 level. And because we see that price is forming a corrective structure that is making higher highs and higher lows, and we can draw a trend line, we opt for a trend line as an entry trigger. Again, an entry trigger tells us when we should enter, and when price finally breaks the level, we can go ahead to take the trade. And it will look something like this. I will list down a couple of entry triggers that you can use shortly, so keep watching. But before that, I want to touch a little more about using triggers. Now, the advantage of using a trigger is that you will know where to place your stop loss. Without an entry trigger, knowing where to place your stop loss can be quite tricky because you have not seen the turn in the market yet. And because of that, you will probably use a wider stop loss and that affects your risk to reward ratio. Now, as an example, if you have two traders who take the same trade, one takes it blindly at the level and the other waits for a setup. Here's the stark difference in risk to reward. And this might mean the difference between being profitable and losing money, if the first trader isn't able to get his win rate high enough. So hopefully you see that having an entry trigger is very important, and it is mandatory that you use it when you are using leading indicators. Because you are predicting turns in the market before it actually happens, further confirmation via an entry trigger is a must. In fact, if you watch my other videos or download the free day trading guide, which you can find in the description down below, almost all of them always consist of these same three elements: sizing up the market context, identifying key levels, and watching for a price entry trigger. As promised earlier, here are a list of entry triggers that you could use with leading indicators. Number 1, price action candlestick patterns, like the piercing candle and engulfing candle, which I covered previously. Number 2, trend line break, which I also covered in this video. Number 3, chart pattern slightly double top or bottom, head and shoulders or inverted head and shoulders. And finally, number 4, lagging indicators, which I've actually gone through in depth in the How Institutional Combine Leading and Lagging Indicators video. So if you want to get the most out of this video, definitely check that video out next. To sum up this video, most newbie traders are using leading indicators wrongly by thinking it's a crystal ball and they blindly trade off the indicator's level. Leading indicators can give you a real edge in the market, but only if you use it correctly. You need to combine leading indicators with the market context and an entry trigger if you want to use leading indicators effectively. And that's it for this video. I will leave a link to the video on how to combine leading and lagging indicators in the end screen here. Thanks for watching. I'll catch you in the next video.